All right, let's tackle a big one, the credit default swap. I know, it sounds super complicated, right? It's one of those terms you hear in movies about the big financial crash and your eyes just kind of glaze over. But what if I told you we could break down this whole thing by just talking about a kid's bicycle? Well, that's exactly what we're going to do.
So just imagine this for a second. Your friend comes over and asks to borrow your amazing brand new bike. They promise, they swear, they'll bring it back tomorrow in perfect condition. But you know that little voice in the back of your head? It starts whispering, what if they crash it? What if they just don't bring it back at all? That little feeling of risk right there, that's where our whole story begins.
So you decide you need a backup plan. You walk over to another kid on the playground, maybe the one who always has snacks, and you make a little deal. You say, hey, here's 10 shillings. If my friend wrecks my bike, you have to buy me a new one. And they say, sure. For a small fee, you've basically gotten rid of your biggest worry. You've bought yourself some peace of mind.
And that's it. That's the big secret. That simple little deal you just made on the playground, you just invented a credit default swap. Seriously. At its absolute core, it's not some crazy, complex thing. It's just a promise to cover a loss in exchange for a fee.
So let's dive into our first section here, the bike and the promise. We're going to see how this super simple idea, protecting a promise, is really the heart of this whole financial concept.
Okay, so let's put the official name on it. A credit default swap, or CDS for short, is basically a type of insurance. But here's the key twist. With regular insurance, you're protecting a physical thing, right? Your bike, your house, your car. With a CDS, you're insuring something you can't touch, a loan. And what is a loan really? It's just a promise that someone will pay you back.
All right, so let's keep building on this. Our next section, insurance for a loan. We're going to take what we learned on the playground and see how it works in the real world.
This slide lays it out perfectly. On the one hand, you've got your regular insurance, protecting stuff you own. On the other hand, a credit default swap protects money you've loaned out. So instead of you and your bike, imagine a huge bank that just loaned a company $100 million. That bank might be a little nervous, so they'll go out and buy a CDS to protect themselves just in case that company can't pay them back. Makes sense, right?
So far, this all seems pretty logical. It sounds like a pretty smart way to manage risk. But now we get to our next section, the weird betting rule. And trust me, this is where the story takes a really, really strange turn.
Okay, let's go back to our playground analogy for a minute, because this question is everything. What if you're a third kid, just watching this all happen? You didn't lend out a bike, you don't even own a bike, but you still go up to that other kid and buy protection on your friend's bike anyway. Why on earth would you do that?
You do it because of this one single game-changing rule. You do not have to be the one who made the loan to buy the insurance on it. You can have zero skin in the original game and still buy a credit default swap on that deal.
And that, right there, changes everything. Because if you don't own the bike, you're not actually insuring yourself against a loss. You're just making a bet. You're betting that the bike is going to get broken so you can collect the money. This transforms the CDS from a shield into a weapon. It becomes a way to bet that a company, or even an entire country, is going to fail. And that very idea, the ability for anyone to bet on failure, brings us right to our next, critical section, when the promises broke. This is how a clever financial tool got mixed up with massive bets and became a central character in the 2008 global financial crisis.
So here's the quick and dirty timeline. In the years leading up to 2008, banks and financial firms sold a mind-boggling number of these credit default swaps. For every one loan out there, there might have been 10, 20, even 50 bets placed on it. They were collecting fees left and right, making promise after promise. But here was the fatal flaw. They didn't actually set aside enough cash to pay up if all those promises came due at the same time.
And then, the unthinkable happened. A huge number of mortgage loans all across the United States started failing. All at once. The very thing all these bets were placed on was actually happening, and on a massive, terrifying scale.
The result? Absolute, total panic. Everyone who had a winning bet suddenly rushed to collect their money, but the institutions who sold the swaps, they didn't have it. The promises were broken. It was like thousands of kids showing up to that one kid's house demanding a brand new bicycle, and she's only got enough money to buy a handlebar. The entire system just froze.
So, wow, that was a ride, huh? From a simple bike on a playground all the way to a global economic meltdown. So after all that, what's the one thing you should really walk away with? Let's boil it all down in our final section, your one-sentence takeaway.
If you remember nothing else from this,
remember this sentence. At the end of the day, a credit default swap is just a promise where someone pays a little bit of money so they don't lose a lot of money if a loan goes bad. Whether it's for protection or for a bet, it all comes back to that simple exchange.
But, the real lesson here is so much bigger than just finance. Any healthy system, whether it's the global economy or just a bunch of kids on a playground, it runs on trust. It runs on the idea that people will keep their promises. And when too many people start making promises they can't possibly keep, it's not a question of if things will break, it's only a question of when.
And that kind of leaves us with one final big question to think about. We saw how this exact thing brought the entire financial world to its knees. So when we look around today and we see people and institutions making all sorts of promises they might not be able to keep, you have to ask yourself, what breaks next?